Welcome back to RealPage Economy Express. Today we focus on the latest trends across various sectors of the economy. Starting with the labor market, May's data shows a solid increase in non-farm payroll employment by 272,000 jobs. Despite this growth, the unemployment rate held steady at 4%. In the private sector, employment surged by 152,000 positions, with annual pay growth marking a notable increase of 5% year over year. Turning our attention to construction, April saw a marginal dip in total construction spending, just 0.1% below March's figures. Yet, year-over-year data reveals a robust increase of 10% from April 2023. This growth is mirrored in private residential construction, which edged up by 0.1% from March, indicating continued investment in housing despite broader economic uncertainties. In public construction, spending dipped slightly by 0.2% from March, with notable reductions in educational and highway construction. Turning to the labor market, the number of job openings remained stable at 8.1 million by the end of April, though this is down by 1.8 million from the previous year. Hires and total separations also show little change, standing at 5.6 million and 5.4 million respectively. Quits held steady at 3.5 million, indicating a consistent level of employee confidence in the job market. In the realm of inflation, the Consumer Price Index was unchanged in May, following a 0.3% rise in April. Over the past year, the All Items Index increased by 3.3%. Notably, the Energy Index fell by 2% in May, driven by a 3.6% decrease in gasoline prices. However, the Shelter Index rose by 0.4% for the fourth consecutive month. Producer prices showed a 0.2% decline in May, following a 0.5% increase in April. This decrease was primarily due to a 0.8% drop in the index for final demand goods, while prices for final demand services remained unchanged. Lastly, the Federal Reserve's latest meeting has left policy rates unchanged. The Fed's summary of economic projections suggests only one rate cut in 2024. The Fed remains cautious, focusing on data-driven decisions to balance inflation risks and economic growth. In our opinion, this year, the most likely timing for the rate cut is in November, although there is also a possibility it could occur in September. In summary, the current economic landscape is marked by steady construction spending, a stable job market, and a cautious monetary policy with inflation largely in check. As always, we'll continue to monitor these trends closely. Thank you for tuning in, and we look forward to bringing you more updates in 2 weeks.